silver is at a crossroads right now. And I mean that literally, not as a metaphor, not as clickbait, as a factual description of exactly where the silver market stands at this precise moment in time. On one side, the data says silver to $105 is not just possible. It is mathematically inevitable if current trends continue. On the other side, the data also says silver to $70 is possible, if specific things break down, if specific risks materialize. Most channels will tell you one or the other, because one answer gets more clicks. Because certainty feels better than complexity. I'm going to tell you both. And more importantly, I'm going to tell you which one the data currently supports, and what you should watch to know when that changes. My name is Stack AG, and today, the truth nobody's telling you. Before we talk about 105 or 70, let us establish exactly where silver is right now and why this moment is so critical. Silver is currently trading in a range that has significant technical and fundamental importance. After a dramatic run from the low 20s to the mid 80s, silver has been consolidating, moving sideways, testing support levels, testing resistance levels. This consolidation is happening at a price level that would have seemed extraordinary just 18 months ago. The fact that silver is consolidating above $80, rather than collapsing back to previous levels, tells you something fundamental about the strength of the underlying trend. But consolidation always ends, always. Markets do not move sideways forever. They build energy through consolidation, and then release that energy in one direction or the other. The question every silver investor needs to answer right now is this: which direction does that energy release? To answer that, we need to look at two completely separate sets of data. The bull case data and the bear case data. Not selectively, not with bias toward what we want to be true. Both sides, objectively, because the market does not care what we want. The market goes where the data leads. The bull case for silver at $105 is built on 5 independent pillars. And the strength of this case is that every single pillar is supported by publicly verifiable data, not opinion. Pillar 1, the gold-silver ratio. Gold is currently trading above $5,000 per ounce. The gold-silver ratio sits at approximately 65 to 1. The long-term historical average of this ratio is 47 to 1. If gold holds current levels and the ratio simply returns to its historical average, silver's mathematically implied price is $106 per ounce. $106 from ratio compression alone. Before any additional silver-specific demand, before any supply shock, just from the ratio returning to where it has historically always returned. Pillar 2, industrial demand acceleration. The Silver Institute's latest data shows industrial silver demand hitting record levels and continuing to grow. Solar panel installations globally are accelerating beyond even the most optimistic projections from 2 years ago. Electric vehicle adoption is expanding. AI data center construction is consuming silver-containing components at a pace nobody predicted 18 months ago. This demand is not speculative. It is not based on sentiment. It is factories ordering silver, manufacturers consuming silver, real physical demand that does not disappear because of a bad day in the futures market. Pillar 3, COMEX vault drainage. We have covered this extensively on this channel. Registered silver inventory at COMEX continues declining. The physical silver backing the paper market is leaving the system. When physical supply tightens against growing industrial demand, price has only one mathematical direction to go. Pillar 4, central bank gold, buying driving ratio compression. Central banks buying gold at record levels pushes gold higher. Gold going higher with silver lagging expands the ratio. Expanded ratios historically compress violently when silver catches up. That compression has historically taken silver to levels that seem impossible before they happen. Pillar 5, institutional money rotation. BlackRock published bullish silver analysis this week. When the world's largest asset manager publicly turns bullish on silver, institutional capital follows. Pension funds, endowments, sovereign wealth funds. That capital entering the silver market on top of existing industrial and investment demand creates a demand wall that current supply cannot match at current prices. 5 independent pillars, all pointing to $105 or higher. All supported by verifiable public data. Now, the bear case. And I want to be clear about something before I present this. Presenting the bear case, honestly, is not pessimism, it is not weakness. It is the only intellectually honest way to analyze any market. Anyone who tells you there is no bear case for silver is either lying to you or lying to themselves. The bear case for $70 silver rests on 3 specific risks. Risk 1, dollar strength persistence. We are seeing dollar strength right now, driven by rising bond yields and technical short covering. If this dollar strength is not temporary, if it reflects a genuine Federal Reserve policy reversal back toward rate hikes, the impact on silver would be severe. A sustained strong dollar reduces international demand for dollar-priced silver, and reduced demand at current price levels means price falls to find new demand. $70 represents a significant technical support level where new buyers historically emerge. Risk 2, industrial demand disappointment. The bull case assumes solar, EV, and semiconductor demand continue accelerating. But what if they do not? What if the global economic slowdown reduces manufacturing output? What if EV adoption stalls due to infrastructure challenges? What if the AI investment cycle peaks earlier than expected? Industrial demand is the pillar that separates silver from pure monetary metals like gold. If that pillar weakens, silver loses its most powerful fundamental driver. Risk 3, COMEX inventory replenishment. What if new physical supply enters the COMEX registered inventory system? Large eligible silver holders converting to registered status. New mining output entering the vault system, recycled silver increasing supply. If registered inventory stabilizes or grows, the physical squeeze narrative that has been supporting prices loses credibility. And when a market narrative loses credibility, price adjusts rapidly. These 3 risks are real. They are not certain, but they are real. So, the moment you have been waiting for. Which scenario does the current data actually support? I'm going to give you a direct answer. Not a hedge, not a both sides conclusion that leaves you exactly where you started. A direct data-driven answer. The data currently supports the bull case significantly more than the bear case. Here is why, specifically. The 3 bear case risks require things to happen that are not currently happening. Dollar strength reversing the Fed rate cut cycle, not currently happening. Industrial demand disappointing, not currently happening. COMEX inventory replenishing, not currently happening. Bear case risks are real, but they are potential future events, not current realities. The 5 bull case pillars are not potential future events. They are current realities. The gold-silver ratio is elevated right now. Industrial demand is at record levels right now. COMEX vaults are draining right now. Central banks are buying gold right now. BlackRock is publicly bullish right now. When you have 5 confirmed current realities supporting one scenario versus 3 potential future risks supporting the opposing scenario, the data favors the confirmed realities. That does not mean $70 is impossible. It means the probability distribution heavily favors 105 over 70 based on current data. And probability is all any honest analyst can give you. Markets are not certain. Data improves your odds. It does not guarantee outcomes. The data currently improves your odds significantly on the bull side. Here is the part that most channels never give you. The specific signals that would change this analysis. Start by understanding what you are buying before you buy it. Physical silver, what it is, why it matters, how to buy it safely from reputable dealers. Not from YouTube channels, not from DMs, from established, verifiable, reputable, precious metals dealers with track records. We will never sell you silver on this channel. We do not sell anything. Anyone claiming to be Stack AG and offering to sell precious metals or investment products is a scammer. Block and report immediately every time. Silver at $105. Silver at $70. 2 scenarios, both possible. One significantly more supported by current data than the other. The truth that nobody is telling you is not that silver definitely goes to 105. The truth is that the data makes 105 dramatically more probable than 70. Right now, based on verifiable publicly available information that most retail investors never look at. And the truth is that this analysis changes. Markets change, data changes. Signals change, and when they change, Stack AG will tell you. Before the mainstream does, without agenda, without something to sell you, just the data. That is what this channel is built for. Every vault report, every ratio update, every central bank decision, every institutional signal, every day. So that you always have the information to make logical decisions instead of emotional ones. Subscribe, hit the bell. Share this with one silver investor in your life who is stuck between fear and conviction right now. I am Stack AG. I invest with logic, not hype. See you tomorrow.